Closely held companies might be enjoying sky-high valuations, but some are taking steps to bar shareholders from conducting trades on secondary markets, as we've been saying. Our next guest is an attorney who works with startups and venture capitalists. Ted Hollifield is a partner at law firm Dorsey Whitney. Ted says it's in everyone's interest to let the company conduct an effective and organized offering of the shares as opposed to an ad hoc leakage of the shares. And Ted, I'm so glad you're here because this whole process really is still so opaque to outside observers. Give us an idea of what goes on between the companies, the exchanges, and the people who want to buy these shares. Is there just insane demand out there?
Well, there absolutely is. So there are people who would very much, they're huge fans of these companies. They've followed their performance and growth over time, and they would very much like to participate in that by being shareholders of the company.
So are employees just getting bombarded with phone calls from people who are interested in buying these shares? I mean, how does that work?
I think absolutely. And there are a lot of people who would love to participate each time companies like this are raising money. And people are following developments like Second Market, like Shares Post, and seeing these as potential opportunities for them to become shareholders in these companies.
But you're saying that most of the people who do end up selling or want to sell are actually former employees.
Absolutely. There's some very interesting things about the way that legally services like this need to operate. One is that, recall, these are private companies. That's the reason the shares are scarce in the first place. With private companies, one of the main advantages the private company has is its ability to not have to disclose everything about what is going on with the company. That means for current employees, very often they'll be prevented from selling because they do in fact have insider information, and they cannot profit, even in private company stock, on that insider information.
But former employees presumably aren't beholden to any of those rules.
Right. Former employees who are no longer with the company no longer have access to that information, but are nonetheless still shareholders because of their service, are in fact able to participate in these sales, again, depending on their contractual arrangements with the company. And interestingly enough, I think Second Market has reported that over 90% of their closed transactions have come from former employees.
And what are the most desired companies? I mean, we know from Second Market and from Shares Post that Facebook accounts for more than 50% of the shares being traded. But what are the other companies in demand?
So really, the main demand is for companies that people actually believe are on an IPO track and may go public in, say, the next 12 to 18 months. Certainly, there's a lot of excitement about Twitter. The other interesting statistic is well over 80% of the interest appears to be for consumer internet companies.
Okay. Now, how do you see this market playing out over the next 1 to 2 years? Do you think down the line these secondary exchanges are even going to exist? Will companies be able to regain some of the power?
Well, today is a particularly interesting day to ask that question because I think whether these exchanges continue to exist and the size of these exchanges has a lot to do with what happens in the public markets. I think a lot of people would really like to see a much more active IPO market than we have seen over the past few years. And I think we can point to the absence of IPOs as one of the things giving rise to the interest in these companies.
Can secondary trades happen without these exchanges? There are now many other ways to do this, right? Through mutual funds and hedge funds.
Absolutely.
Down the line, do you think secondary exchanges may no longer exist?
Well, I think there is a clear issue of equity and fair treatment here. And I know a number of these companies have taken these steps to reduce trading on secondary exchanges because they think that there's an issue with a lack of equity between their current employees, who they have an interest in treating as favorably as possible, and former employees who are able to kind of take advantage of really what is kind of a scarcity in the shares to not only obtain a fair price, but in some instances a price that is billions of dollars in valuation above the exact same price at which sometimes the company itself is issuing shares to investors.
So many fascinating dynamics going on there. All right, Ted Hollifield of Dorsey Whitney, thank you so much for joining us here on Bloomberg West.